Everyone, thank you for joining us for today's episode of The Capitalist Investor. I'm Mark Tepper, joined by Derek Gabrielsen. What up, D?
Mark, how's it going today, man?
Good, buddy. How are you?
Pretty good. Pretty good.
So we get to talk some fun stuff today, man.
Awesome.
Fun idea for today's show. Because I think, we probably both think about it from time to time. We have some clients who think about it. And that is vacation homes. Are they an investment? Okay.
An excellent topic.
Because you can definitely trick yourself into thinking it's a really good investment.
Yeah, right.
I do that all the time. But then you got to start doing the math a little bit,
Yeah.
So we're going to talk about that today, and we're going to kind of just work through the numbers, work through the concept, and just break down kind of the pros and cons of maybe purchasing a vacation home and or whether or not you should consider it as an investment or if it's just a place for you to enjoy.
Right.
So what's your take, first and foremost? Why don't we start there, and then we can kind of go through this piece by piece. Is a vacation home an investment, or is it just consumption?
So, I guess it really depends, in my opinion, on kind of the fine details.
Yep.
But what I would say is it's definitely more on the consumption end,
No doubt.
Versus the investment side.
Yep.
But it can be. It can be more of an investment. It just depends really on how much time you want to spend to realize some of that investment return back.
And how much you actually going to get. Like, what's your net return?
Exactly.
Right?
Exactly.
I think a lot of people look at the appreciation of their property. So you're lucky enough to buy a place in California or something like that where appreciation has just been astronomical.
Right.
That's not your return.
Mm-hmm.
There's costs that go against that return, right? So we need to figure out what the net return is. But, D, I think I'm kind of in the same camp. I think a lot of us, our clients, we all have these dreams, these goals, these aspirations of, potentially one day owning a vacation home.
Mm-hmm.
Some people think vacation homes are the dumbest thing in the world. They'd rather not be tied to one place. They'd rather vacation. Totally cool. Whatever floats your boat. But we do have a good handful of clients who've asked us this. I was asked this a week ago on TV. So, I figured it'd be kind of a fun thing to talk about. But, first and foremost, buying a vacation home is, without a doubt, it's consumption.
Oh, yeah.
Without a doubt. Now, and I think you need, if you're interested in buying a vacation home, I think you need to enter into that arrangement thinking that, right?
Mm-hmm.
And if there's an investment component, well, that's really just icing on the cake.
Exactly.
Right?
And I go through this, like you said, building out the financial plans for our clients, for my clients. It's a pretty commonly asked question, I would say. And probably, not to get off topic, but another real estate related question is, when I retire, should I pay off my mortgage? Right. And then and question number 2, hey, I've always wanted to downsize here in Ohio and get a vacation home.
Yep.
And, we've been going to this place forever and we like it and we think we can get a house for this amount of money. And if we wanted to, I think we could rent that place out for X amount of dollars per month.
You think.
Exactly.
But then the question is, do you want someone else, multiple people, sleeping in your bed? I don't know if I'd be cool with that, man.
Yeah, especially not these days, right?
Yeah.
Mm-hmm.
So, you raised a good point, right? Some people trick themselves, and maybe there are people who really enter into these arrangements dead set on renting that thing out. Mm-hmm. And for those people, I apologize. You're doing the right thing, but there are a lot of people I've talked to throughout the years who claim they're going to rent it out and they never do. Mm-hmm. This is just like our clients who claim that they are going to retire and then work part-time in retirement.
Right.
What percentage of them actually do?
Very, very few actually do.
I mean, maybe 20, 25%.
I'd say even less than that.
Less than that, yeah. So don't trick yourself into thinking that you're going to be getting some sort of revenue or return on your investment when the chances are pretty low that you're actually going to do that. Mm-hmm. So let's go back to paying off your mortgage, and then we'll get back into the vacation home stuff. So when your client asks you, let's just assume I'm 62 years old. I'm retiring next year. D, should I pay off my house? What's your typical response to that?
So my typical response to that, if they're in a position to do so, and what I mean by that is, not pulling a giant chunk of money out of their IRA accounts, 401k account that's going to take
like hundreds of thousands.
That's going to take an enormous tax hit up front, just to kind of make them feel better on the other side of not having any debt. That's obviously kind of a non-starter.
Yep.
It's just,
I agree.
There's no way it's going to be worth that, just because of the timing and the taxes.
Yeah. Yep.
Now for other people that have, say a smaller balance, let's say like $75,000 or something like that, and let's say they have a non-qualified investment account, and let's say there's $300,000 in there. I would tell them, if I were to run the straight numbers and assume kind of a normalized rate of return on the investment account side, the math would probably tell me it is not better to take
Correct.
the lump sum out and
Yep.
pay off that amount.
Almost always.
Almost always.
Yep.
Those people who are in a position to do that, however, if it just makes them feel better, helps them sleep at night, and it's, again, not a huge tax hit or anything like that, I will tell them, hey, you are in a position to do that. I don't think you're going to be making money on the transaction, but I don't think you're going to be losing tens of thousands of dollars.
And I feel the same way. So, I mean, I tell my clients something very similar. And, it's the math is going to tell them not to pay it off.
Right.
Because if your mortgage is 3-4% and you're able to earn, 5% on your money, if it were invested, obviously there's some positive arbitrage there and it would make sense to not pay it off. But as you're alluding to, if you're close to the end of a mortgage, if you've got 5 years left on a 30-year, if you've got 3 years left on a 15-year, if you're kind of at the tail end of that thing and there's just a small nut left for you to pay out, sleeping at night is what's most important.
Right.
Exactly. I mean, look, peace of mind is what it's all about. So, I agree. The math is going to tell you not to pay it off, but, we all want to enjoy ourselves. I mean, that's the most important part of developing a good financial plan for people is to make sure they have peace of mind.
Absolutely.
Right. All right, so back to the vacation property stuff. So let's talk a little math here because I brought my calculator because I didn't prep for this at all, So we're going to have to do some math here. But I'm trying to figure out, let's assume you were to buy a vacation home.
All right.
Okay. And let's assume you are lucky enough to realize 6% annual appreciation on that real estate.
Okay.
When's the last time we saw 6% in Ohio?
I don't even remember, honestly.
20 years ago?
There's certain pockets in Ohio that have done pretty well. But as a average Northeast Ohio, even coming out of the 2009, 2008, 2009 recession, I can't remember those kinds of numbers.
No. And then alternatively, our coworker Peter out in the Bay Area.
Oh yeah,
that dude can't get a 2-bedroom apartment for less than $1 million.
I know, it's crazy.
Totally. There's different areas, right?
Mm-hmm.
So let's assume you're able to get 6% appreciation.
Mm-hmm.
I think one of the fallacies that a lot of people have is that is their return.
Right.
They feel really good about this is great, man. I'm going to go buy this vacation home. I'm going to have so much fun. I'm getting a 6% return on that thing.
Exactly.
Come on. No, it doesn't work that way.
Yeah, there's a few costs along the way.
Yeah, there are, right? So first things first, you have your mortgage, your mortgage interest, okay? And if you say, well, I'm paying cash, that's a whole different discussion because then your cash could have been invested somewhere else and now it's opportunity cost. So let's just assume it's the same either way, all right? And there's a mortgage. Now, if you're really lucky, you can get a 3-ish% mortgage right now. Now, that's not on a jumbo loan, and some people may want a jumbo mortgage on their vacation property. Others need something much more reasonable. 3.5%, somewhere in that range, depending on whether you do a 15 or a 30, or what are you seeing?
I don't know. If you already have a primary residence and the bank knows that it's going to be a second home and a second mortgage,
That's a good point.
I don't think you can get a 3 to 3.5% mortgage.
You are right.
I would say is probably more like 4.25.
All right, so let's use 4.25. So that is your first cost, which is your mortgage.
Yep.
4.25%. Okay. So if you were getting 6% appreciation, your net return already 6 minus 4.25 is 1.75%.
I didn't even need a calculator for that one.
I needed it. I have it. I did not use it.
I had it open though.
I promise you, I didn't use it.
My brain doesn't work as fast as it used to 3 months ago.
Well, we're also addicted to computers now, right? So, all right. So your net return is 1.75%.
Right.
Is that good?
No.
It's not very good. All right. Let's add on other costs, because some people would say my return is 6%, and they stop there and they love it and they buy their house and they completely dupe themselves. The next set of people, they subtract the cost of the mortgage. At least they're starting to think the right way. That gets you to 1.75% as your net annual return.
Right.
Now let's subtract the other stuff: taxes and insurance and HOA fees. Okay, so that is probably going to be 2 to 3% per year.
Right.
Okay.
Easily.
All right. So what are our costs here? Now we are looking at 6.25 to 7.25 a year. I think we're losing money, D.
Already.
Neither of us are good at math, but I think that's bad. All right. If we're making 6 and it's costing us 6.25 to 7.25, it sounds like we are losing money. What about upkeep and maintenance?
It's huge, and it's a pain in the butt. And,
Yeah.
You know, I think something I wanted to interject when we started to bring up this subject. You know, just I feel like since we were kids, you know, everyone was telling us, hey, you know, buying your home, that's the greatest investment that you'll ever make.
Yep.
And what a scam that was.
Yeah. Yeah.
All I do is dump money into my house.
Yeah.
and I don't get anything
You'll never
back.
get back what you put into it.
No.
Never.
No, it's ridiculous.
Yeah.
And, you know, landscaping and fixing stuff that breaks all the time.
That's why multifamily investing is such a good deal.
Yeah, exactly.
Right? I mean, paying rent is better than owning a home nowadays.
No doubt.
And actually, there's a lot of baby boomers and millennials who are opting to go that route.
Oh, yeah.
Right? I mean, why be trapped in one place when I can rent here in Cleveland and then visit my kids in Austin, Texas, and San Diego, California?
Yep.
Not be tied to one place. So we are seeing some of that happening with clients, right? Selling their houses and renting.
Yep. But yeah, back to your point, upkeep, especially upkeep for a rental, you know, is going to be higher than a regular house that you're just living in. So
let's assume you're not renting it out at all.
Okay.
Let's start there. Okay. So you're just using it for consumption, right? 2% of the home's value per year?
Yep.
In upkeep? I mean, is that a good estimate?
I believe that's what we're using now in our financial plans. It's either 1.5% to 2%.
You got a $500,000 house, $10,000 a year. That sounds right. Maybe one year it's $5,000, the next year it's 20, right?
Yep.
It's not bad. $2 million house. You know, now you're talking much bigger numbers. You're talking, you know, 40, 50 grand a year potentially. All right. So let's add on 2%.
Okay.
So now we're at 8.25 to 9.25%. That is the cost associated with owning a second home per year.
Right.
8.25 to 9.25%, based on today's very, very low mortgage rates. Okay. That does not sound like a good investment.
No.
Unless, even if your real estate's appreciating at 10% per year, you've got a large chunk of money. You've got a big financial commitment there, where net you're getting maybe 1%.
Right.
Not good. Not good.
No.
Okay. So I think the lesson here, D, is if you are buying a vacation home for consumption purposes, to use it yourself, it is definitely not an investment.
No. You would need to see astronomical return appreciation on the property to have any kind of break even.
So, I mean, for it to be an attractive investment, you'd have to hope for at least 15% annual appreciation,
right? Just
for it to be attractive. For it to be, you know, unbelievable, 20% annualized appreciation,
right,
into perpetuity. That's tough.
Yeah, and the markets like, you know, New York City, California, that happens sometimes, but then it can kind of go down the other way pretty quickly as well.
Right.
New York City real estate right now, I don't think is going to be too attractive a spot from the levels that people were paying 3 months ago.
Yeah, I would say it's definitely going to come down, right? If people even, well, part of that is because who knows how many people are still going to want to live in the city.
Right.
Right. I mean, public transportation, do you want to use that? Hey, maybe you want to go move out to the suburbs, get a house, and just drive in by yourself every day, right? So maybe it changes the way people live in the New York area. All right, so using it for consumption, which is what most people do, not an investment. What about if you plan on renting it out? If you'd go on Airbnb, VRBO, and when you're not there, you're renting it out. I mean, what's your take there?
Well, my take is kind of how much time, that would be my first question personally. How much time am I personally going to have to spend to turn a profit, and how much is my time worth?
Yes. So when you try to calculate the returns, you technically have to pay yourself a reasonable wage. Right? Because you're really not doing it for free. Well, I mean, you're doing it for free, but your time's worth something.
Yeah.
Right?
Yeah, you know, I've talked to a buddy, lives in a different state. You know, basically, he felt if he was breaking even on his mortgage that, you know, he was basically racking up the 6 to 10% depreciation on the property that we're just talking about. I'm like, whoa. Even if that's true, I mean, how much time are you going to have to spend to make that happen?
Yeah.
Right?
Right.
And then what happens if someone doesn't pay you when they say they're going to? There's just a whole host of issues that can come up that I feel that most people who I have these conversations with aren't really thinking about their first time when they're running the numbers in their head.
Yep. All right. So, I mean, let's try and arrive at a number here.
All right.
So here's what I got, bud. We had the mortgage at 4.25. Okay. We've got HOA. We've got taxes. We've got insurance, somewhere in that 2 to 3% range. Okay. And then we've got upkeep at 2% per year.
Yep.
Okay. So we're all in at 8.25 to 9.25.
All right.
Now let's assume, let's just use a snowbird as an example. Okay. So you get a place in Florida, in Arizona, and let's just say every January through April. So 4 months a year, you are at your winter home. Okay. 8 months out of the year, you try to rent it a little bit here and there. And who knows, maybe you get a week a month. Right. Maybe if you're lucky, 2 weeks a month. I would say best case scenario, you're going to offset the cost of the upkeep. Best case scenario.
I would agree with that.
And that's before you send in the cleaning crew to clean up after the peak, because there will be additional expenses. Right. So maybe rather than 2% upkeep, now it's 3% upkeep because you have other people staying in your place. Right. So now we're talking a 9.25 to 10.25% cost associated with that property. So assuming having someone renting from you maybe a week or two a month for 8 months out of the year, best case scenario, that wipes us clean on the upkeep portion. We're still on the hook for 2 to 3% for taxes, insurance, and HOA, and 4.25 for the mortgage. So our cost is still 6.25 to 7.25.
Right.
And if it's appreciating at 6, you are still losing money.
Correct.
Now, one other thing you may want to consider is the cost of a vacation. Okay, so maybe you say, well, if I didn't have this place, I would have spent $15,000 on vacations over the course of that, year, which I'm no longer going to spend money on that. So maybe there's an argument to add that back, right, as a positive cash flow.
Yeah, that's a great point. Honestly, I never even thought about that.
Yeah.
But I just did that with one of my clients in their financial plan. They bought a place in Florida. They absolutely love it. I'm real happy for them. But yeah, I basically was able to take out the vacation expense line item in their financial plan.
Yeah.
So they're happy and their expenses went down.
Yeah.
So that was a good one for them.
One of the reasons I wanted to do this is because I was a little heartbroken this morning. in my basement working out in the morning, and I see something from CNBC come across my phone. It says mortgage applications to purchase a home were up 21% year over year. Dude, my dreams have been crushed. I was hoping to get a good deal on a vacation home in about 6 to 12 months.
Yeah, around mid-March, I'd say, if you were in the vacation home market, you were probably feeling pretty good.
Jeez.
Man, that turned around quickly.
It did. It's unfortunate, but who knows? I mean, we'll see what happens. So, why are mortgage applications up 21% year over year when headline unemployment's 13.3%, I believe, but the real unemployment, when you add back the people who were misclassified, is more like 16.3 or 16.6, something like that.
Yep.
So with so many more people unemployed, how is this happening? So we either have some overly optimistic home buyers,
right?
And unfortunately, they're going to realize that maybe they're not getting their jobs back. I don't know. Well, I don't know how to explain this.
I can't explain it.
Yeah.
I know it's not going to make for the best content right now, but yeah, it seems like across all facets of the economy, everyone seems to be kind of just shaking off what just happened.
Yeah.
Like in 3 months, it will be like it never happened.
Yep.
And are just plowing ahead with their investments or real estate investments, things like that. So now that everyone seems to think that we've turned the corner on this coronavirus stuff, people are out there and they're out there spending.
Yeah.
And I can tell you just from my own development, which is a new development, there's probably 60 lots still left. In the last 2 weeks, the traffic at the model homes has increased for sure.
Has it?
There's been a lot more cars, a lot more people looking.
Some pent-up demand, huh?
Yeah, so I think pent-up demand might have a little bit to do with it. I'm not sure about the year-over-year results, how much of an impact that would have. But people are out there spending.
Yeah.
They're out there spending like nothing happened.
We have a resilient consumer, but at the same point in time, they're spending like nothing happened, but did something happen?
Yeah.
So I think something happened.
Yeah, that's for sure.
So I mean, we'll see. Hopefully everything's positive, but there's certainly a chance that some people may be making the wrong decision, which unfortunately would lead to another financial crisis. Real estate issue. Let's hope that does not happen, though.
Yeah.
Well, for my sake, though, I hope real estate prices come down for me.
Yeah.
I need to at least dream about owning.
At least in Southern
I've been
California.
thinking about buying a vacation home for over 10 years now. I'm just waiting for the real estate market to come back down to earth, but it just keeps going up.
Yeah. And for the folks listening out there, we live in Cleveland, and it's a great town, and the people are amazing.
Great, standard of living is very,
awesome.
very affordable cost of living.
And we both traveled quite a bit. Just amazing people. It's a nice place to be around. But in January, you're getting a little stir crazy, right? And
No
you could
doubt.
use some sun, maybe some golf in my case. Although I know you're getting back into it.
Trying to.
So yeah, looking at these spots is something that kind of people do as like a hobby. Take a look at a certain location and see what the prices are. So I know I'm not really doing that right now, but I grew up. Our family vacation in upstate New York. So my kids are young now. So I would like a summer lake house that I could take them to. I don't necessarily need to own it, but I want to try to get them on the water because I enjoyed that so much when I was a kid.
Yeah, something within driving distance.
Yeah, exactly.
Yeah, no, that you get a lot more use out of that than having to fly across the country without a doubt. Well, good stuff. Anything else you want to talk about with regards to this?
No, I think real estate, is one of the more misconstrued investments out there. But at the end of the day, it really comes down to just like anything else. If you get a good price at the beginning, it's likely you'll make money. If you're overpaying in the beginning,
it's just like buying a stock.
Yeah,
right?
Exactly.
The number one determinant of your return in the stock market is where you bought the stock at.
No doubt.
Right, your entry price.
So just be careful if you're out there listening, as these prices just keep going up and up and up. That doesn't last forever.
Yeah. So I just to kind of wrap up, I would say enjoy the property if it's a goal of yours, if it's in your retirement plan, enjoy it, have fun, but don't trick yourself into thinking it's an investment.
Right.
We really just ran the math both ways, whether you consume and actually just use it for personal use, and then if you use it for personal use, but also try to rent it out in some of the off-season months. And there's still a big hurdle for you to cross, somewhere in that 7 to 10% per year range, depending on which route you go down. But beyond that, there's also the issue of liquidity.
I was just going to say that.
Right. I mean, that's the last thing is you put your money in a property, it's completely illiquid.
Right.
You have your money in a CD at the bank, thing's liquid. You have it in the stock market, it's liquid. Now, if it goes down, if the stock market drops 20, 30%, I could argue that you're paying a penalty to get your money out, but it's still liquid. Right. And you could certainly do the same thing with real estate. You could fire sale your house if you really needed the money, but I could fire sale all the stocks in my portfolio right now and get my money right now. You could fire sale your house, and you might be 90-plus days away from getting your money. So it is illiquid. Good stuff today. As always, thanks for joining us. If you have any questions, email us, info@swpconnect.com. Check out the show notes on our website, and we have a bunch of links in there for our YouTube page and stuff like that. So thanks for joining us, and we will talk to you soon.